Saturday, the 22nd of October. Welcome to this weekend's analysis. I'll go over this mystery chart at the start of the video, then go over silver on multiple time frames, gold, as well as the gold to silver ratio. This chart is merely the points per game in professional football, that is, since it begun in the year 1920. And I want to go over this mainly because I want to talk about consciousness and radical changes more than anything, because I think that can be important for a lot of different things. So we'll go through this, so bear with me if this has very little interest. I'm going to go over it a little quick, but not so quick overall, though. Okay, so at the start of this campaign of football, or I guess the first few professional years, it was low scoring games in the 16, 17, 18 points per contest, which obviously is nowhere near today's average. There was a lot the game was played a lot differently back then, for there really wasn't a quarterback position, and well, no one really knew how to play that. Once you figure something out and you do it from mistakes, then that makes things a lot easier. And I say this as we move into a new economic system. We're going to be making mistakes on many facets because we're not doing something that we don't know how. People didn't know how to throw the football back then. Nobody even knew how to shoot a slap shot in hockey back then because nobody figured it out at that point. Once they figured out how to pass, the scores kind of started going up through the roof, really. And since that point, it's went sideways for quite so many years. And I was stating I think it's going to break through. And when you look at what's going on within its game and how they're protecting the quarterbacks, and again, how the position in itself is just getting better. Back in the year 1932, we were going through the bottom of the stock market and really into the Great Depression. The average quarterback, or the average passing stats per game, was about 4 of 11 passing. They completed a third of their passes, 53 yards a game, and they really never threw many touchdowns. And they threw an interception, obviously, every 11 throws. Well, since the days have been moving on, we are now at the day and age where we throw for 233 yards, which is better than the 173 that we managed well back in here. Now, why were the points scored so high? I have to think a lot of these interceptions occurred when they were on their own side of the field. And then the running stats, 151 yards. That is just magnificent, to say the least. But you change something and you do things differently. So let's look at something like this chart again and think, what would it look like if we take an example of happiness or wealth or prosperity by eliminating a debt-based system? Because this had a big run, and then we're never going back here again because we know how to keep this level higher, that is. And let's just talk about happiness or anything of that nature. Once you eliminate what's stopping you from being happy, then the results are just going to be magnificent. Now, another big thing too is when you make radical changes in something, like say you decide you just want to get out of banking completely or as much as you can, then your life will go through major radical changes as well. For if you really don't do anything to change up, and then everything's going to remain the same. It does look as if we are nearing the end of the fiat debt-based currency systems, and that's going to just make a lot of large changes within the culture. I don't know when the currency is going to go, but it does seem very close. Now let's get on to the action, and we'll move on to silver. We'll start with the half-year chart. We'll do multiple time frames from the longest to the shortest. And this year of 2011, we've got only two candles for the year, the first six and last 6 months. And the first six was one where it closed pretty much where it started, which is a small gain. And it challenged both the upper and lower bands. And we're doing the same thing again, which is showing sideways consolidation over a short term, which is only two candles. after you had a nice gain, and then of course a sideways action. But what's interesting, if you look at the price in here, we have the price of silver at $50, and it was interesting. The food that I ordered on Friday was pretty much about 160, excuse me, 1,600% more or 1,400% more than it was in here. Yet the price of silver is cheaper. Very much an interesting thing. Same with gas prices and almost everything else. But really, these numbers to me are just a bunch of nonsense anyway, because if currency does say goodbye, the debt-based system, I like the chances that it does, then this is something that will go in history and be that of history. And that, of course, is why the gold to silver ratio is very important. We'll go over that at the end of this, but now let's move on to the quarter year chart and just a little okay size correction, a decent size as it came back down to this overall upper band. And if it does come back down anywhere to these levels, as I've been stating, very good chance there'll be a decent sized disconnect within the physical market and the paper market. Monthly chart, we've now made one lower low and one lower high so far. The low is 26 and change. We'll say 26 even. And the high will go 44.5. So now what's it going to take out first? Is it going to take out this high, or is it going to take out a low? Sometimes if you're going to need to correct, a lot of times the consolidation is oftentimes within the high and the low, which means that whenever it goes in the range bound, it's probably not going to go over this or much over it. Same within this level in here. However, when you break one of the other, or whichever one breaks first, that is, if you break below this line here, then you're looking for the possibility to have that washout final move that would most likely bring us close to this Fibonacci line here, which is currently set at 1997. Basically 20 flat is an easy number to look at that as. When you break through above this level here, this could be telling us that this correctional phase that this market is going through could be coming close to an end, or at least we're now at the upper range, that is. Now let's move this on to the weekly chart, and this line right in here, right where the price action is consolidating at, is located at 31.21. That's within the Fibonacci levels of the February 2010 lows and the highs from this April. And it's a significant level because of the Fibonacci upside, which is set at 2094, which broke, of course, in the fall, but a little over a year ago. And then the next one was 3140-ish, 3142. So in this exact same ballpark level. And the next one was 4836, where it topped. So this is a very large level, to say the least. And any momentum within this brings us, of course, towards that 50 level. But if, of course, if you get a hold within this mark here, that tells us that we had only one level of upside Fibonacci that that we retrace back to. In 2008, we went from the 21 level, which is where we topped, down to 846, which pretty much was the top of the range, which is $4 to $8. So it pretty much came back the entire level to the resistance that was so big. So that level was previous support. So the next big one is 20. That's why 20, I would expect, if it hits there, that we could say goodbye, and the market's now going to be going a lot higher. And goodbye, of course, to the lower prices, because you're going to have uptrends, sideways, down, maybe sideways, up. The overall trend, long term, of course, is higher, but it does a lot of these miscellaneous trends within its primary trend. Moving on to the 3-day, and this contains very close to that of a 50-day moving average, which we can obviously see is declining. No test yet within that level. If we draw a line from this mark in here, we have came back and found resistance basically at where we were finding support. I don't even need to draw that line in there. It's just extremely obvious for that to be the case. The Fibonacci lows is 1883, which just happens to be one of the lower numbers that it's okay. The best way of explaining it is it automatically has taken away lower numbers every time a new 3-day series comes in. So this number is going to slowly rise a lot higher. But this ballpark area for Fibonacci support, I have the 34, 35, 27, 30. Well, the numbers that I've given out before, which are the 3358 and the 2630, are pretty much the best ones to use. So the 3358, which would be a little bit in here, it really doesn't make much of a difference, but it does though, because this level has been hit twice, and this was actually pretty much hit as a resistance level. And for 2630 as support, then it was obviously a nicer hit on the lower end when it came down there earlier last month. The daily chart is consolidating within this band for quite some time, but not only with that band, but it's consolidating within this Fibonacci mark, 4422, which is the most recent highs and the most recent lows, so it's a very valid Fibonacci point. And when it's finally done consolidating at this level, whenever that happens to be, and it's either going to break out or break down, it's got to do one or the other, it's most likely going to do it really fast, which means you have a fast move to here, maybe a 2-3 candle, 2-3 day move, up to this level here, about 36 and a quarter, 36 and a seventh. And if it obviously breaks down below the significant support levels, mainly here at the 29 and change mark, 29.50, then it can have that quick move down to that big level at 26. And of course, anytime it breaks below it, the movements can get extremely fast. As far as the quarter day is concerned, this, as far as its chart, is just a bunch of nonsense. This isn't the type of chart you'd be looking to day trade by any means, because there's just no trend really whatsoever. And the longer you're in this range, the bigger the breakout or breakdown happens to be. Let's now move on to gold. And we're going to be using the daily chart within the gold market. Now, what I find interesting is the size of the moves now compared to back then. So what we're going to do is eliminate everything from this big green candle on, and just look at all of the red candles before that breakout one. Where would a big green candle be? Well, we had a nice breakout here, a nice size move here, and they're the exact same size as the candle we had today, which is a very small candle, although we've had a lot of small ones the last few days. So the volatility movements, of course, are much larger. A lot of times when you see that, that means something is going on and something's got to give, basically. And we do have the Webbot and people stating that maybe this is the month where things break down, and I don't know if it is, I don't know if it isn't, but as far as the real fundamentals and current events are forming, it's a no-brainer that this Ponzi scheme is getting exposed, and it's got no choice but to break down at some point, and guessing that point could be extremely difficult. And right now, if you look at the markets, the way the Dow set up, it made a high not seen in 2.5 months. Gold, on the other hand, it made a high not seen since Wednesday. Well, but anyway, it's still hugging along this band, this Fibonacci line at 1633. It represents the breakout low in here from this low to this high. So therefore, as long as it holds this level, the rally has not failed. So it's doing so thus far. If we have that breakdown below here, most likely that's where silver will be breaking down to go to 26. And if silver goes to 20, gold will most likely at least go down to 14. The market, of course, it's a paper market, so You're not going to get rational price movements, but if a paper game that's been manipulated and totally off within its commodities, and you in a real physical process of recovery, one of the processes within the recovery is that of revaluing the assets. That's why I like the physical gold and silver, especially silver, because it's the real deal. It's on the periodic table of elements, and fiat cash is not. Now, if this market does manage to move higher, I'll be looking for this level to be resistance, which is 1738. If we hit the 1738, what would be ideal is to come back down to this level of resistance, roughly at about 1690, 16-ish or so. And getting up there, what you'd like to see before it gets there, something like this, and then come back, find support, and then breaking by this level. That's when it's time to get really bullish on the gold market, finding that within strength. Now let's move this to the gold to silver ratio. And the ratio right now is that of about 52 and a third to 1. And this chart brings us back to 1968. Standard uptrend was violated, and since this uptrend has been violated, it's mainly been range bound, and the range has been pretty much going on since in here. Really, even since 1971, 72, it's been in a range. The lower end of the range is, no, because this was resistance here, so I can't count it. But the lower end of the range is about 40. The upper end of the range is roughly around 85. It's been, though, up to this 100 mark. And most recently, it went down to 30 this year. I've pulled across, I've done some Fibonacci numbers on here. And what I have is the 1980 low of 1399 and the 1990 high of 178, which is this low and this high. So therefore, within this information, I have two numbers, 47 and a half and 29 and 3/4, we'll say. So the 47 number will just plot somewhere in around here, and then the 29 and 3/4, and even be just a little bit above it, but pretty much roughly around this mark in here. It was first established in here, so all of its importance is from this point forward. So the first time it came down to this level, it had a nice level of support, keeping the market in a bullish state within the ratio. Then it bounced, but it made the lower high before coming towards this area, increasing the chances that it broke it, and it didn't. But again, you're concerned on a rally that it's going to make a lower high and then come back lower. Well, it really didn't. It made a matching high, or it created that of a double top formation. A double top is a situation where you just make two lines where the peaks are about the same, and they have tested the support level twice. Once, of course, here, once in here. Now, after it broke below this Fibonacci mark, it pretty much came down to this level, pretty close. And after it has rallied from this point, this mark is neutral, and it's back in the bullish stage again. Now you have to have the caution side for which is the failed move. Because this level is supposed to be support, and it wasn't. So is a failed move going to be the fact that it went below it when it wasn't supposed to? If that's the case, you would expect a test to the upper part of this range above around 85 and change. But now that we've gotten above this Fibonacci level and a decent mark above it, then we need to be concerned that this might be that of a failed move, a failed breakout above the 46 level, because this was a previous prior level of support. This level of support was resistance for a little bit in here, but really not that long, and now it's above it. So if this, of course, is the failed move, you would expect at least to test again back down to this level here. Now, if you break through this Fibonacci mark, then that really is where you nullify the trend of this market from here towards here. And the next significant support level would be roughly in here. You can also do the Fibonacci on a 23.6, and that would probably roughly be around 20 or so, 21. Now the next one is April of 2011 and October of 2008. That would be the, I'll show you these levels again. That's from here to here. That was the market crashing in October of 2008. And the significant levels that I have are 45.72 and 57.62. But what I'll do for this is I will shorten the time frame out and just only show the last few months or so. And now we can see things just a little bit more clearer for what's happening within today's time frame. We're really just talking about the new stuff. So 47.40 I want to focus on before we go into the old ones. That's the significant level roughly and just a little bit above here. So it was staying below it for a decent amount of time. Obviously it's not anymore. The new levels 45.72 and 57.60. So 45.72, roughly somewhere in here. That was a level where it found resistance. Stayed below it for a while within this range, but when it finally broke out, it did it fast. That's very normal. And it usually breaks fast to the next level. What's the next level? 57.62. So where would that be about? I guess somewhere about here. Maybe even pretty much dead on, because this only takes a few records a day. It takes one in the morning at 9:30. It takes one again in the middle of the afternoon, and one again at 4. So we came back to this now significant resistance point. If we break above this again, then you would expect a continuation for the fast moves. However, because we're at a significant resistance point, the odds are favoring that if we don't hold this level, we'll at least have a test back again down towards this 46, 47 level, which is a magnificently important mark to say the least. But Fibonacci has been holding really well within the silver and gold charts, so I wouldn't expect it at this point to stop working well. Another thing I just see in here is you can make a case for this little symmetrical triangle. We're really just trying to find decision for this move. Is this a real move or not? And I'm going to end it at that because I have absolutely no idea. But thank you for watching. Take care.